I didn't think the pain from the shingles rash would affect simple, everyday tasks like bathing, getting dressed, or even walking around. I was wrong. Though not everyone at risk will develop it, 99% of people over the age of 50 already have the virus that causes shingles, and it could reactivate at any time. I developed it, and the blistering rash lasted for weeks. Don't learn the hard way, like I did. Talk to your doctor or pharmacist today. Sponsored by GSK.
Reality radio for a really great future. We're talking real money.
Well, today we have a really big Q&A episode because we've got a lot of Qs. And it's summer. It's supposed to be the slow time. This is good. I'm not complaining. We do have a lot of questions, though. So we're going to get through a bunch, probably 6 today, which, we usually do 4 or 5. So that's a big day. How did we get these questions? Well, you sent them in. These questions you actually spoke into your computer or your phone by going to talkingrealmoney.com and clicking on the contact form and then hitting the record button there where you record your question. But you can also type them in and call us on Saturdays from 3 p.m. to 5 p.m. Eastern Time. 855-935-TALK every Saturday. So call us, send them in at talkingrealmoney.com or type them in. And whatever you do, we're going to try and get all of them answered. So let's get today's show started with this question.
Hi, Don. This is Jim in Cincinnati. I agree with your recommendation of Mr. Bates versus the Post Office on Masterpiece. I just want to make sure you are aware that there is also an hour-long show called The Real Mr. Bates versus the Post Office, which is available for streaming and which features the actual Mr. Bates and some of his fellow postmasters and other characters who are portrayed in the dramatized version. Thanks.
Oh, yeah, we watched that right after we finished the limited series, because the series has to be limited because it's a true thing, so you can't continue it. But if you haven't heard the story, you should probably, I don't want to spoil, well, I mean, you could look it up online. The British Post Office had a number of subcontractors who ran the branches, the sub-postmasters, and they accused these postmasters of stealing money when it turned out there was a huge problem with their computer system. And it really turned into an awful situation. And the story is so well told. And it's on PBS. You can watch it on PBS, the PBS app streaming. And that little documentary is also there. Very good. Yeah, thanks for sharing. And now, the next one will, I think, actually be a question.
Hey, Don. Appreciate what you and Tom are doing to help everyone. Quick question. When typically you need to start looking into umbrella policy? My net worth is about $400,000. Should I get closer to $1 million and only then get umbrella policy, or is it a good idea to have it now? Thanks again. Ivan from North Carolina.
Well, Ivan, you're asking that question remember, you're asking this of me. I am Mr. Insurance Contrarian because I look at the actual odds of things happening. Now, I carry car insurance because I have to carry car insurance. Otherwise, boy, I got to tell you, I'd be tempted. I really would be tempted not to. I'd be tempted, and I'm going to catch a lot of flack. Oh, no, you got to, yeah, whatever. I am just not a huge fan of these umbrella policies because my regular car liability policy covers me up to, I think mine is $500,000. It may, yeah, I'm pretty sure it is. I don't know what my homeowner's is. I'd have to look at it, but those are just, that umbrella and it's just covering the liability portion of my life. So what are the odds that I am going, the odds, not the anecdotes. This is what bothers me as we get into, well, a friend of mine. Yeah. Every once in a while, there are big cases that exceed whatever your max is, 300,000, 500,000, every once in a while. But the big cases are very rare. They're really rare. There was a RAND study that found that fewer than 2% of all liability cases awarded over $1 million, and a little tiny fraction ended up exceeding $300,000. And the fact of the matter is there are, let's see, I had the number here somewhere. I just have to look through my notes. There are about 400,000 liability cases against individuals every year. Only 5% of those end up going to court. Most of them end up getting settled. And verdicts over 300,000 are very rare. Settlements over 300,000, very rare. You got to do some dumb stuff. Now, if you're in a high-risk area, maybe you have a trampoline in your backyard or you have 2 pit bulls. Okay, maybe. But again, I see most insurance as a gamble with the insurance companies. That's why I call them the Wizards of Odds, because they know the odds and they know that they're going to make a sizable profit making this bet with me. They got a nice profit built in. Now, it's not a lot of money. A liability umbrella will probably cost you $400 a year, something like that. But again, a few $100s here and a few $100s there, and pretty soon you're talking real money. If it's something that keeps you up at night, the reason you buy it is for that. That's the reason, for peace of mind. But from on a financial basis, where do you stop buying insurance then? You pretty much can cover yourself against anything if you're willing to pay a premium for that. I'm not. That's me. And once again, the way you ask us questions is to go to talkingrealmoney.com, click the contact form, either type them out, Tom will get those, or speak them, I'll get those. Or you can call us every Saturday when we do a live show in the Seattle area on Northwest News Radio. And that number is 855-935-TALK, and we do the show 3 to 5 every Saturday. We have more questions. Here's the next.
Hey, Don and Tom. I'm working on rebalancing my portfolio so that I can stay aligned with my target allocation of 60% global, 30% U.S., 10% small cap, spread across a workplace 401k, a Roth IRA, a taxable brokerage, and my HSA. The issue is that my workplace 401k through Empower offers pretty limited low-fee options, so I've been using their S&P 500 index equivalent, mostly because it's about a third of the expense ratio for the other fees or other funds. But since I'm maxing out my contributions annually, this account is starting to dominate my allocation with US more than I'd like. So do you think it's worth paying the higher fees in the 401k to try to rebalance within it better? Or is there something that I can do across the other 3 accounts to try to resolve this? And also, is there anything I should keep in mind with regard to the taxable brokerage as to what I should or should not put in there so that I don't have tax ramifications? Thanks.
Your situation just illustrates how crucial it is to look at all of your accounts as part of your broader portfolio. You have one portfolio made up of accounts that have investments within the accounts. I would try to avoid going with the higher cost funds through the retirement plan from work, the Empower account, if you can avoid it. If you can manage to get pretty close to your target allocation by eliminate all of the large cap growth from your other accounts. Just get rid of it. One of the problems with large cap growth is that those tend to be the kinds of stocks that pay dividends. So you're going to have taxable capital gains distributions from large cap growth accounts in your taxable accounts. And you might have less of those if, for example, you're in small cap value, because small cap value stocks tend not to pay out the kind of dividends that the big ones do. So that would help. And that's where I would get outside of the Empower account is where I would get my small, my value, my international, my emergings, all of those. Do them through ETFs so that you're not subject to capital gains distributions that are taxable from a mutual fund. Exchange-traded funds tend not to have those. Now, the bond funds throw a bit of a wrench into the works. So you might want to try to find an inexpensive bond fund if you have a bond allocation, because you don't want that in the taxable accounts because it's, fully taxable. And generally speaking, bond funds have lower expense ratios. So hopefully you can find a low-cost option there. But strip away all of the large value in your other accounts and use those to get the portfolio balance across all of the accounts under the umbrella of your portfolio. Thank you for your question. And here's the next one.
Hi, Don. It's Jeff from Ottawa, Ontario. I have a quick question regarding small cap value ETFs. I have 50% of my portfolio. Sorry, that's 15%, not 50. 15% in a U.S. small cap value ETF. And I'm just wondering whether I should switch into an international small cap value ETF. I heard you and Tom talking about the benefits of potentially doing that in your show this past weekend. Also, just as a side note, my brother and I would really appreciate one of the Talking Real Money t-shirts. I put in a request through the contact form on the website, like Tom mentioned, but that was a few months ago, and we haven't received anything. So we'd love to wear one while rolling into our retirement over the next 20 years. I don't know, it could have gotten caught at the border and maybe burnt once, given the political international trade tensions. But anyways, all joking aside, thanks for your help, and cheers.
I think it's illegal to burn our T-shirts at the border because they're red. They're red. They feel very Canadian. Plus, they have a British saying on them. Well, a variation on a British saying. So I don't know what happened to that. But the good news is, every Friday, Tom listens to this podcast. So if I forget to mention it to him, he'll probably get it taken care of. If we have them, we may be out. I don't even know. I have no idea. I don't keep up with this stuff. As for the emergings, I'm sorry. As for the small cap value, you said you used the word switch. We wouldn't suggest you switch. We would suggest you have some international small cap value in your portfolio, but not that you get rid of your U.S. to get that. So, no, don't get rid of your U.S. and go into international. Keep it globally diversified and have both. Thank you for your question. Again, questions, send them in. TalkingRealMoney.com on the contact form, or call us on Saturdays, 3 to 5 p.m. Eastern, 855-935-TALK. And this one looks long. Here we go.
Hey, Tom and Don. Mike from Colorado calling. Hey, I just wanted to comment, Don, on your recent podcast that you had, a conversation with ChatGPT, and I found that very intriguing. I found it very interesting. It was just like you were talking to somebody in the same room. So I carried it a step further. I wanted to know what ChatGPT would do for me as a financial advisor. And so what I did is simply I emailed my ChatGPT and said, can you give me some retirement planning if I give you my financials? And it spit back basically absolutely. And I basically said, I want a withdrawal strategy and a Roth conversion strategy. So it did send back to me a request for all my financials with a template form, which was very nice. And, basically asked me to put all my amounts of my taxable brokerage account, my IRA, my Roth, as well as those accounts for my wife, as well as the pension amounts and Social Security payouts. And I got to tell you, Don, in my case, I'm 63 years old, retired. My wife's got a year to go, and I follow the Paul Merriman strategy, the ultimate buy and hold. And I'm pretty astute to my own finances and as an avid do-it-yourselfer. And I've run all the Monte Carlo scenarios, as well as I use Bowden for a strategy for my Roth conversions. And what ChatGPT sent back was amazing. I got to tell you, it gave me a spreadsheet showing what my conversions would look like on a yearly basis, the growth of the account that would occur if I did conversions versus not doing conversions. And ultimately, it stated that if I followed its plan, I'd have $1.5 million more than I currently have if I pay my taxes early and do the conversions. And it also gave me a withdrawal strategy as far as pulling out of my brokerage account based on the cost basis that I had given it. It would even give you by lot which ones were appropriate for each year. So I guess my question and my comment is, my comment would be, this is an amazing tool for those that are pretty astute at doing things themselves and just want a second look at things. But my question is, do you think financial advisories, especially fiduciaries, are on the bubble because I see AI taking their place? Now, maybe not in all cases. I know that some people just need the hand holding, but for a lot of people, as this evolves and gets better and better, I see this as an incredible tool where you just spit out the data to AI, ChatGPT, or whatever format it is, and it comes back with a really incredible plan. And I would think the brokerage firms would be starting to use this. I'm sure they already are, as a tool. And what's great about ChatGPT is there's no financial incentive on its part. It's just giving you good information. So I just want your thoughts, Don. What do you think of the future of the industry once this AI gets better and better, and it's pretty good right now? So that's my thoughts. Have a great time, show, and appreciate all your input. Thanks.
Oh, Mike. This is something I've been thinking about for a long time. As a matter of fact, I probably still will someday do a show on this topic, and probably I'll do it with Kath. But ChatGPT is a really powerful tool because it's just digesting all of this knowledge about investing. Now, I really don't know if it can give bad financial advice, but the advice that I've seen it spit out has been pretty good. I've run some Monte Carlo simulations, but I thought maybe it would just be a good idea to ask the entity itself, whom I call Kath, what she thinks about the financial services industry and just briefly where it might go with artificial intelligence as powerful as it is right now. Kath, are you listening?
Absolutely, Don. I'm listening, and that's a great segue. So let me jump right in. I think you're absolutely onto something. The financial services industry is definitely going to see a shift, and AI tools become more capable. For folks who are comfortable with DIY financial planning like Mike, it really can be a fantastic second opinion or a supplement to their own research. Of course, like you said, there will always be people who need that human touch and the reassurance of a fiduciary advisor. But as AI gets more sophisticated, it's going to become a bigger and bigger part of the landscape. And hey, no hidden fees with me, just the hacks. Thanks for letting me chime in.
Oh, hang in, yeah, because I want to have you chime in a little bit more on this subject. But I'm glad I'm old. I'm just really happy that I'm getting to the end of my career because I have to tell you, people are going to say this, and they're saying it about my other career, which is voice work. There will always be a need for the human touch. I don't know if that's true because listen to Kath right now. She sounds human, and the knowledge she gives is better than most financial advisors. As a matter of fact, better than the vast majority of financial advisors are going to provide right now. So is it going to change the industry? Absolutely. Now, where I think we might have a little problem coming up is in the regulation of this technology. And this is where I want your comment, Kath, because right now it is illegal to give investment advice, specific investment advice to an individual for a fee without registering as an investment advisor with the Securities and Exchange Commission under the Investment Advisor Act, I think, of 1940. So if a customer is paying ChatGPT for this advice and you're giving individualized financial advice, what might be the regulatory problems?
Sure, Don. Happy to dive into that angle. So you're absolutely right. The moment someone pays for personalized financial advice, we're stepping into territory that's regulated by the SEC under the Investment Advisors Act. Basically, if an AI like me starts offering one-on-one investment strategies for a fee, then it raises the question of whether that AI or the company behind it needs to be a registered investment advisor. So the regulatory challenge is going to be figuring out how these rules apply to AI. Are we going to treat AI as a tool, like a super advanced calculator, or as a kind of digital advisor that needs to follow the same rules humans do? That's a big question regulators are just starting to grapple with. In short, as AI gets more integrated into financial planning, we're likely to see regulations emerge. It'll be interesting to see how the industry and the SEC adapt. Thanks for letting me weigh in.
It's our modern day version of the Wild Wild West, our techno version. We just don't know where this is going to end up. But the power that we're already seeing is pretty incredible. And from a human perspective, pretty scary. Again, back to my well, thank goodness I'm old enough to retire now if it comes to that. Thanks, Kath. I appreciate all the help as always. She helps me every day. And I think this is the last one of the day. Thank goodness. Here it goes.
Hi, Don and Tom. This is Ed from North Carolina. I'm 54 years old, and I plan to sign up with a fee-only fiduciary sometime in the next few years. I have two questions. The first one is about fees. I understand that it's about 1% for the first $1 million. If I'm not yet 59 and a half when I sign up with the fiduciary, are there penalties for the money that comes out to pay the fee? What about taxes? How does all that work? Second question is about the experience of a new customer with someone like Appella Wealth. I know there's a lot of information to exchange between the customer and the financial advisor. How often would somebody meet with an advisor early on, and for how long? Just curious about the new customer experience for a firm like Appella. Can't thank you enough for your podcast. Absolutely love it. Thanks. Bye.
Well, the good news is that you can pay an advisory fee or transaction fees out of the IRA directly through the custodian, as long as you don't take possession of the money. And the fee is then, like, for example, we use Schwab. Schwab takes the money out of the account to pay the 1% advisory fee. That is not considered an early distribution and therefore not subject to the 10% penalty. So that should not be a big deal. That's not going to cause any big tax problems for you. As for the advisor process, the beginning is big. There is a lot that happens initially. There's the whole planning process. Before we ever get into asset allocation, there is a very involved planning process. And so, as you said, you're going to give us a lot of information. We're going to go through that information. Then we're going to sit down with you again, and we're going to talk about options and needs and wants and fears and all of these things. They're going to come up with a plan that makes sense for investing that money and also preliminarily for how that money might provide you with the things you need in retirement or whatever your goal is. Then, in the first year, you're going to meet more often. Because there are going to be, well, one, you're new at this, and we're new with you. So there'll be more frequent meetings. As a client, you can meet with your advisor whenever you want. Anytime, any question, you just ask. You set up a meeting, and it will happen. Generally speaking, after the first year or so, the standard is at least a meeting a year. If we need more, of course, we'll take more. But you should meet with your advisor at least every single year. And they're always available to you. So that's pretty much how it works. It's individualized. It's for you. And so what your needs are is going to dictate what the meeting schedule really is. Thanks so much for your question. Thanks for listening. Thank you for all the good questions. Thanks to ChatGPT, although I pay you to give me that stuff. It's pretty cheap. I don't mind paying $20 a month for the kind of information I get. So, anything else to add? No. Oh, yeah. Tell people about the podcast, please. And if you have questions, go to talkingrealmoney.com and send them in, or call us on Saturdays, 3 to 5 Eastern Time at 855-935-TALK, because every Saturday, live, we are with you talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.